Bismillah, alhamdulillah, wassalatu wassalam ala rasulillah. I'd like to welcome every one of you to this Task Force number 3 webinar. Task Force number 3 focused on infrastructure investment and financing. When we look to this issue, it's one of the important issues in economics, as the strong link between infrastructure and inclusive economics growth. This relation is affecting the growth through infrastructures through two types. One, through the efficiency, where they contribute to improving the efficiency of the economy and reducing the cost overall, connecting people, and reducing the risk on private sector, which will enhance the investment from private sectors. Second, it will affecting the growth through productivities. Assets that built by public investment in infrastructures will help to increase the productivity. Theories in economics and also a lot of empirical studies supporting this notion, and a lot of analysis found out the strong relation and how it will reduce the inequality, how the infrastructures, if it's built in right and more efficient way, will improve the inclusive growth, will connect people, will reduce the cost on them, will improve overall welfare of mankind. Therefore, the need to support this, the investment in infrastructures and try to post this growth to reflect the real impact, positive impact on the growth as we move on. There is two problems facing us usually in such a situation. First, spare capacity on fiscal policies, where fiscal policy, they have a limited space when it's come to the available resources to reach the needed fund to fulfill the supply, to close the gap between supply and demand. SDGs goals, which the 17 goals been agreed in 2015 by governments, they conclude to achieve this one, they need to invest heavily in infrastructures. The total needed investment has been estimated by IMF as around $12 trillion from 2019 till 2030 for more than 122 countries, developing and less developed countries. So when we consider this amount of money needed to close the gap and to achieve the SDGs goal, then there is a huge need to push and post public investment in infrastructures. Given the current situation for developed and developing countries, where the total debt to GDP on most countries is reaching now globally, actually reaching 226% of the GDP, which is really huge, and give limited ability for the government to use the debt to increase its public investment. Therefore, the need to open more floors and encourage more private sector to engage. But engaging the private sector fund to invest more in infrastructures need to solve the inefficiency, where a lot of empirical studies been done, and they pointed out to a lack of efficiency globally, and it's become systemic in most of these countries and globally. We found out most countries, they facing the same problem or losing some of the fund been invested in infrastructures. IMF estimated around maybe a third of what have been spent on infrastructure is lost. In developing countries, this situation actually become around 50%, which when we look at it from resource availability, this is waste of resource. And this amount of money could have been either reduced the tax in such countries or used in different public investment that will help the economy. And the main cause of this issue is the lack of efficiency, which is mostly because the corruption, lack of governance systems, also lack of right institutions in place, the lack of transparency, accountability. All these issues contribute negatively to the situation and make this one more negatively affecting the growth and increasing the risk on private sector to engage on investing on infrastructure. So if we need to encourage more private sector to be engaged, then we need to solve also these problems. Otherwise, if not been solved, then we expected the risk is higher and private sector need to increase their rate of return to engage. And the one who will pay it at the end is the citizens. And this will affect the whole growth in such countries and at the end on the globe. So we need to tackle the issue of efficiency with all causes that lead to the inefficiencies, either corruptions or maybe lack of accountability or availability of data, whatever. And this is hopefully will post and help more of private fund to be engaged on infrastructures and close the gap between supply and demand. And this will have the positive impact that we are looking at to encourage the growth. Therefore, at Task Force 3, we try to tackle these issues and also tackle if there is any innovative way or innovations on public on infrastructures need to be think of or engaged, then we need to have it. So with the hard work of authors of policy papers and leadership from co-chairs and an excellent assistance from CAPSARCs, we've been able to come up with a list of an excellent papers that tackles these issues and try to come up with a more policy-oriented solutions that hopefully will lead to a positive result to the whole globe. At the end, we summarized in our task force statement that will be available on the website later on, and also all the papers will be available. We tried to summarize the main idea and suggestions coming out from these policy papers to make it more available and helping the G20 to more actionable way and suggestion that will have a positive impact on our globe. Today, we have the opportunity to have this dialogue and discussions, and I welcome each one of you, and great thanks for your participations, and also special thanks for the co-chairs of Task Force 3 for their support and help, and also special thanks for authors of policy papers who really work hard and been able to adapt all the recommendations and edit that they received from the co-chairs and from the secretariat to adapt and improve the quality of the paper, which we thought now the paper on the level where it will have really positive and right impact that we need to on the policies. And special thanks also to the T20 Secretariat for their support, and for Mohammed Al-Dubayyan for his excellent assistance on assisting all of us on this task force and managing the communication among us, and also with authors of policy papers. Now I will turn the mic to Mohammed.
Thank you, Dr. Rajal Marzougi. Today we are delighted to have Dr. Sonabi, Dean and CEO at Asian Development Bank Institute, to give an opening keynote speech. So please, Dr. Sonabi.
Thank you very much for the kind introduction. It's a great pleasure to deliver the keynote address at this webinar to so many people participating. Oh, now 77, it's great. But before starting, I'd like to congratulate the T20 Secretariat on the success they have achieved so far. And on behalf of ADB Institute, I'd like to promise to cooperate further with the Secretariat so that T20 Saudi Arabia will be completed successfully and leave many significant and impactful outputs. ADBI is very keen about this because ADBI served as a secretariat at T20 Japan last year. And naturally, we have a feeling of camaraderie or comradeship. The next slide, this slide is okay. So our former dean, Professor Yoshino, worked very hard to put together the 10 sets of recommendations into T20 Summit Communique 2019. Among the recommendations, number 4 was about infrastructure investment and financing, today's topic. So, and then that number 4 recommendation had the 3 parts. The first was to maximize the impact of quality infrastructure investments through land trust and by tapping by tapping spillover effects, boosting long-term returns. Second, to boost quality infrastructure development by integrating impactful environmental solutions. And number 3 was to develop strategies for enhancing resilient infrastructure development. Of these 3 recommendations, the first one, that is land trust and spillover, that one is already widely recognized and accepted as a good idea because Professor Yoshino has energetically advocated that idea at every opportunity. Today, I'd like to add some important points to his argument. My new points are about human factor. More concretely, it's about human resource development through capacity building and training. Yeah, just Dr. Raja just said, he pointed out the importance of addressing remaining inefficiency. Yeah, I agree completely with him. I think the first step to address the inefficiency problem is capacity building. And then by adding this point of view, I would like to deepen the original argument and also to widen it to cover the second and third recommendations, that is environmental sustainability and resilience. Yes, so this colorful slide illustrates the basic structure of the original argument. So first of all, quality infrastructure can be defined as infrastructure that contribute to sustainable development goal. And then this contribution of quality infrastructure investment can be direct or it can be also indirect through enhancing income generating activities of various sectors, areas, and agents that are not necessarily the direct users of the particular infrastructure, but they can be even non-users to whom the benefit of infrastructure spills over and then through maybe forward and backward linkages, and even through the macroeconomic effect of aggregate demand increase. The question is how to increase the infrastructure investment? An important answer would be to attract private sector investment. But how can we do that? Maybe a good answer is to increase the private rate of return. That is the return that private investors would receive. But this is not very easy, as the next slide illustrates. Okay. In this diagram, the infrastructure company or utility in charge of the middle box, infrastructure building, operation, and maintenance. Yeah, not necessarily all of them, but yeah, in total, I would call them utilities. The utilities in this diagram receive only the kind of fees, payment from direct users, while their infrastructure will generate spillover effect, which would lead to local economic development and income growth, but not receiving any money from the non-users. The next slide illustrates a kind of partial solution to this, which involves kind of M&A. So if the utilities or infrastructure company are allowed to own many businesses which are the kind of beneficiaries of spillover effects, and then the infrastructure company can appropriate some of the spillover effects. Okay. And this business model is now exercised on a large scale by platformers that provide digital infrastructure. And also on a smaller scale, private railway companies in Greater Tokyo, for example, and elsewhere. These railway companies provide transport service for people commuting from suburb to the central business district. And this company own and operate many businesses, especially with residential area development and the supermarket along the railway, that area as a core business. So more investment in equipment for better transport service would attract more residents along the railway, and they spend money at the supermarket owned by the same company. So this business model was in practice in Japan before the war, and also it is still working up to today. But they cannot expand this kind of business further, just because land is now too expensive to purchase. So next slide, please. As this slide emphasizes, once the land price go up, that may be result of economic development, it's very difficult for the infra company to obtain land for infrastructure, as long as they try to purchase land. Okay, but as the next slide indicates, what you really need as an infrastructure company is not the purchase of land, but if you can not the entire land title, but what you need is only the use right, and then you just borrow land. Okay, but for that purpose, the land owners have to rent out, but for that purpose, you have to have a kind of trust relationship with landowners, because landowners would worry about the non-payment of rent in future and those things. So that's why the trust bank, this green part, the second from the left, this is very important. This trust bank really play an important role to establish the trust relationship between the landowners and the infrastructure company. Okay, so this trust bank will ensure the continuous payment of sufficient rent, and also trust bank watches the infrastructure company to make proper use of the land. But this will allow this will reduce the kind of acquisition cost of land significantly. But it is not really tap the spillover effects. So that's why we will need the spillover tax. The next slide, this slide shows. Go back to this. Go back to the previous. Yes, this one. So spillover tax means infrastructure investment will help direct users, but it will have spillover effects, and then income grows, and then tax revenue will naturally increase. And then if the government share the part of tax revenue increase with investors or trust bank or landowners or any pair of these, then the private rate of return for investors and also landowners will increase. And then they will encourage to contribute more to infrastructure investment. So this is the original idea. So, okay, so let's go to the next slide. Yeah, already I think already everybody understand basic argument, and then Professor Yoshino also argued this point: the spillover effect and hence the tax revenue would be increased further if the private sector, like a direct user and the spillover effect beneficiaries, can receive some financial assistance, like a low interest loan from the government, then their businesses will be more successful, and then they will generate more income, and which will lead to the greater tax revenue, and then higher private rate of return. As the next slide shows. Yeah, so the bottom part, so financial support for micro, small, medium enterprises near the infrastructure. Okay, so last April, I succeeded Professor Yoshino as the ADB Institute Dean and CEO. And also, I received his argument as a legacy. And, but I'm a development economist. And then from the development economist point of view, this argument has some room for improvement. Let's go to the next slide. So according to the recent literature on microfinance, which is an important subject of development economics research, there has been a kind of accumulating evidence that access to low interest loan and that kind of financial assistance plus business training will help both startups and the incumbent far better than just financial assistance. So they're saying, they're showing the very strong, increasingly strong evidence that business training should be added, because those small business people are operating business, but really without knowing even the very basic of management or the marketing. So the business training program will be very helpful for them. And the cost is very small, okay. So compared with infrastructure building. The training subject would be basic and standard practices of internal management and marketing. And then next slide, please. Oh, next slide. Next slide, yeah, this one. So the bottom part, financial plus managerial training for MSMEs will help more. And then the click. So this will increase the spillover effect, and then click again. Then tax revenue will be greater, and then the private rate of return would be higher. The next slide, please. Then not only those beneficiaries of infrastructures, but how about the human resources of those who are engaging in designing, constructing, operating, and maintaining infrastructure? If their skills, knowledge, expertise improved, then the cost of building infrastructure, cost of operating infrastructure, and maintenance cost would be reduced. And then that will increase the private rate of return too. And then how about the policy makers and the regulatory agencies and the policy impact evaluators? Their skills should also be improved. Okay. So these human resources are very scarce in developing countries. And then as long as they may be able to rely on the experts from developed countries, but then the cost is again high. So they should have their own human resources to cope with these activities. Then the training subject should be project management and disrupt technologies. Disrupt technologies should include satellite imagery and mobility data, machine learning, digital terrain model, and those things should be definitely needed for the modern policy design for infrastructure. And also these people, especially policymakers, regulators, should learn from training programs those important expertise, know-hows, and recent or modern technologies for the environmental sustainability and the resilience. And then in addition, maybe please next slide. Yeah. Because this raising the private rate of return involves tax revenue. So why not giving good training to tax officers? Okay. So then the next slide. So yeah, there are three parts in this diagram. So capacity building and training for tax revenue part, and also CBT for utilities and policy makers and regulators, and also CBT for the beneficiaries of spillover effects. Okay, so let me wrap up with this final slide. Next slide, please. Yes. So the main point of the argument still remain the same. So to attract private investment, private rate of return needs to be increased. And then spillover tax internalizes spillover effects of infrastructure. And it will allow the local or central government to collect enough tax and then raise the private rate of return. And the nicely designed and implemented capacity building and training will help domestic resource mobilization and lead to a higher private rate of return. And also CBT should, of course, provide trainees with know-how and technologies for achieving environmental sustainability and resilience. And also, these people should be equipped with expertise to, eradicate remaining inefficiencies in the building and operation and maintenance in infrastructure. But it is easy to say, actually, adult training and adult learning are not very easy. So it's a matter of communication, motivation, and aftercare. And especially, it is a bit difficult to induce those trainees to keep practicing what they have learned. So more research and also international cooperation are needed to do CBT very effectively. I think the think tanks will play very important roles in this area. Okay, I should stop here. Thank you very much for your attention.
Thank you, Dr. Sonabe. Now it's time to have a rich panel discussion that covers different aspects of infrastructure investment and financing with Task Force 3 co-chairs and moderated by the lead co-chair, Dr. Raja Marzouki. Please, Dr. Raja.
Thanks, Mohammed. Thanks, Dr. Sonabe. I think you covered really important topics and issues and how this private sector can be engaged. And let me maybe continue the same discussions. We have now here 5 topics. Each topics will try to allocate around 20 to 25 minutes to cover discussions in this one. And each topics I will give one of my colleagues here, the co-chairs, to give 5 minutes talk about it as an introductions, and we'll open the floor for discussions from participants and also co-chairs to discuss many ideas or differences. During the discussions, I hope any interventions or questions or comments not exceed 2 minutes, so we give more time for more numbers of people to participate. So the first topic has been listed here, and maybe to continue the discussions from what the Dr. Sonabe said, is boosting private sector investment in infrastructures. So I would like to call Professor Mathis to give 5 minutes introduction to this topic before we open it for discussions. Professor Mathis, the floor is yours.
Thank you, Dr. Raja. Thank you also for your leadership and guidance and the valued contribution from all of the members of Task Force 3. Very much appreciated. Our group's challenge is to identify policies that increase private investment, particularly in all the developing and emerging markets. There is a tremendous amount of funds needed in infrastructure investment, but there's also a tremendous amount of funds available for infrastructure investment, and it's just channeling them in the right direction to accomplish what we want to. So we have 7 proposals to do that. First, we proposed that G20, with the support of the UN, the World Bank and IMF, established a board of private investor representatives. The purpose of the board is to educate, simplify, and standardize the investment process by sector. It is getting people together to talk about the issue face to face and ask questions. That is not happening. Second, G20 to request multilateral development banks and project governments to expand and improve risk coverage guarantees, insurance programs, to provide improved default protection for private investment. That is one of the major concerns of many countries that private investors have not gone into. And I should mention, by private investors, I mean not only foreign, but also domestic. And it can be corporation or it can be individuals, as you'll see. The third point is G20 support creation of a secondary market for private infrastructure investors. And this adds market liquidity options to infrastructure investments. Fourth, support creating a G20 infrastructure funding emergency reserve. Emergency reserve to help expedite the launch of infrastructure projects, unforeseen emerging needs during construction, during project completion, and implementation. Fifth, G20 countries considering offering tax credits for member country citizens or companies that invest in G20 infrastructure funding bonds or loans. The purpose of these bonds or loans is to help reduce global pollution and climate change by funding specific infrastructure projects supporting environmental, social, and governance sustainability. 6, G20 support the establishment of a global diaspora infrastructure investment fund to channel remittances into legacy country or global infrastructure project funds. And last, 7th, encourage all governments through G20 member countries' example of providing income or other tax reduction or subsidies, incentives to support all workers that are willing to obtain infrastructure, continuous education in STEM skills that are relevant to adopting new technologies for smart infrastructure investment. Thank you.
Thanks, Professor Matthews, for this introduction. I think you covered really important issues that if we've been able to tackle them, for sure, this would reduce the risk on the private sector, will engage more private fund to close the gap between the supply and demand that really needed in the upcoming years. So now I'm gonna open the floor for discussions. Any one of the participants or the co-chairs would like to add or have a questions, happy to hear.
Yes, Raja, thank you, and thank you, John. I just want to say that there are a few very good remarks and questions that have been shared in the chat room already. So even without myself raising a question or adding something to what John mentioned, I think what Roman Zitek made several remarks which connect with Dean Sonobe's initial inputs, and John also remarks, and maybe John would like to elaborate in particular on one aspect, which is the fact that attracting private sector to infrastructure finance is a major issue, and supporting, as Dean Sonobe has exposed, MSMEs in development through infrastructure finance is probably a good way forward. However, there are a number of hurdles and challenges linked to that. So how can we, I would say, connect the issue of large-scale implementations, large-scale approach to infrastructure finance, and the fact that it connects with local needs, and it is being sort of a real boost for local growth with local stakeholders. I think this would be an important aspect of pursuing the discussion today.
Thank you very much. I was hoping that someone would ask that question, and I have made a long list of positive factors that private investors have looked at before in pursuing infrastructure projects. As you know, in major industrial countries, it is becoming increasingly evident that private funds are pouring into infrastructure deals. Why? They are increasingly global also in their perspective, and that is a risk diversification aspect of going global. You get different economies, different business cycles, so forth. But private equity is used to investing and managing large sums and good at assessing all forms of risk accurately, but they are also not afraid of risk, but good at managing it. Often independent of volatility swings that happen in other markets or other asset classes, such as fixed income, equities, or real estate. Investing in infrastructure have been, in several recent studies, shown to be relatively stable and consistent in their returns. In fact, during the period of the financial crisis, is a good example of how stable those funds actually were in the return. So for long-term known returns, that's another advantage attractive to private investors. Also, the sector tends to be more immune to economic downturns, inflation, or financial crisis. Private equity companies and other private sector companies increasingly are moving away from the view that investments that represent liabilities, and those liabilities come from some pollution effects of certain industries, some environmental damage of certain industries. This is discouraging private sector investment in those funds. And at the same time that it is discouraging them from investing because they see it as a liability, a long-term liability, it's also increasing their interest in investment, infrastructure investment that gets rid of these problems or reduces the problem. That's an extra return, referring to the previous speaker, an extra return that is a benefit to private equity. They are creating something as opposed to knocking down the doors of investing in projects. So those are some of the benefits that private equity and private investors are beginning to see in infrastructure investments. Thank you.
Yes, Shad, please. Nicholas, thanks for, by the way, reading from the chat room. I do not have the chat room in front of me. I think it's controlled here. So if there is any question coming in the chat room, please step in and let us know.
Absolutely.
Shamshad, please.
It's
Unmute.
I have unmuted you. Can you hear me?
Yes.
Okay. I'd like to reinforce John's point in a couple of areas. I think setting up a global infrastructure fund with private sector makes a lot of sense. And I also wanted to mention, and I will cover up in my remarks a bit later, the fact that today we know already that the demand for infrastructure is extremely high, that if more and more of the infrastructure is respecting ESG standards, the environment, social safeguards, governance, there's a lot of financing available for that kind of product rather than plain vanilla risky infrastructure projects. So just by way of example, the global ESG data-driven assets have hit almost 40.5 trillion. So there is money in the system. How do you really channelize that money? The way to go about is to have climate-friendly, sustainable, respect for environmentally and socially responsible investments, and getting the economics and transparency data right for the private infrastructure that are to be developed. Over to you.
Thanks. Yes, I agree. And I think we have no option except to engage private fund. So either we'll engage them in a higher cost on the society if we do not handle the risk, we do not help them to engage in a more appropriate way, or we'll engage them if we solve all the problem that they are facing and increase the cost of doing business for them and increasing the risk, then we'll engage them in a higher cost on the society, and this will have a negative impact on the economy. Because giving the fiscal space that the government has, given the needs for fund in the future, with the higher debt now already government in, and also the limited ability to increase the taxation. So if it's increases, will only generate a small amount of fund, will not be enough to cover the total need. Then the final maybe hope to fund this needed infrastructure is to engage more private sector. But the hope to solve all these issues, to tackle all the obstacles that they are facing, to engage more of them in a lower cost and a competitive way, because if it's not a competitive way, then we will have a negative impact. And I think with the technology now that enabling some of infrastructure, the private sector, to pricing individuals, which not use, this is not the case before, where the public infrastructure is a public and it's cannot be priced on individual. So such kind of an investment in infrastructures can be, with a new technology, have more roles. Yes, Professor Yoshino.
Okay, thank you very much. I think private sector financing becomes very, very important after COVID-19. Many government has to spend for healthcare and other things. Then they don't have enough room to provide money to infrastructure investment. So I think the private sector financing is one of the key to recover our infrastructure investment. That's why John's proposals and Professor Sonobe's, Dean Sonobe's proposals are very important to attract private sector finance. Thank you.
Thanks, yeah, I agree. Novel, I think you have, yes, please, floor is yours.
Yes, well, I also, of course, agree that private sector finance is key, but I think we're at a particular moment in history, and in the case, particularly in the case of developing countries, both emerging and less developed countries, I think they're going through not only a health crisis, but an economic and financial crisis because of declining commodity prices, remittances, tourism, reversal of capital flows, of private capital flows. And the question I like to ask to John is, I think we're at risk also a flight to quality in terms of the infrastructure investment space, particularly in emerging countries, where private sector does have a role in infrastructure investment, has had recently. In less developed countries, it's more the national budget. So I think we need, and I like to clarify, because I think you propose a board of investors, private sector investors, but not a fund. And my view is that in order to crowd private sector investment, we need to infuse additional funds in the multilateral system, in the multilateral financial institutions. And I completely agree with the idea, and I was going to propose that. That's one of my proposals, to set up, this is a very different moment in history. We cannot think about private sector, the conditions for attraction of private sector investment now in these countries with very stretched budgets, with high public indebtedness, with macroeconomic risk that was not present before in some of these countries. I think the only way to crowd in is if we have additional multilateral finance, and some of the concrete tools you propose, for instance, the default insurance, increasing risk coverages, all this is not only financing. We need those instruments, but already the multilateral financial institutions have a very stretched budget also. So the two things I'd like to ask you, John, is whether you need, you think additional infusion in the multilateral financial institutions of capital is needed. And thank you. Second, whether you think that the board of investors should be part of a new fund, or it's just an advisory institution you are proposing?
Very, very good questions, very good observation. A couple of points. You know, the pandemic has had disastrous effects, but it also had, I think, a wake-up call that climate change, particularly here in the United States, climate change is a real issue, and it's probably moving faster than people thought. And therefore, you better start changing your infrastructure more quickly make it very, sensitive to sustainability, there are some obvious problems that you have to ask yourself and scratch your head. Why are we still using coal, which does, tremendous amount of damage? We have alternatives, but they cost money. So how do you get the money flowing into those alternatives? I think the pandemic, like you said, has been a wake-up call to many private sector investors, large investors, that some of the sustainability infrastructure projects and increasingly smart infrastructure projects are needed to rapidly adjust the climate deterioration if we're going to continue on good old planet Earth. So that's one thing. The second thing is how do you get the funds together? Well, what worries private investors in particular, particularly in some of the lesser of the developing countries, some in Africa, some even in Asia, although Asia has gotten quite a bit of investment, mostly in China, has been the issue of governance. It is the private sector's main concern about going into some of the countries in infrastructure investment. And how do you get the awareness? Well, that's partly the purpose of the board also that was proposed, is that the board establishes for the country that if you want private sector, you have to adjust your governance system. No matter what index you use that measures governance, that becomes the criteria for, has the country changed its governance system, its reputation in terms of deception, in terms of illegal activities, use of funds, so forth. How do you change that? Well, if the onus is put on foreign governments, if they want money, then change the way they operate. And then private sector will look at them. That message has to be made very clearly to get more private sector. I think government funds flowing into countries has difficulty emphasizing and using that, because how do you go into a foreign government and say, you're really corrupt and we'd like to have you change before we give you money? That's a sensitive issue. Private sector can do that a little bit more easily and get away with it. But the onus is on countries. If they want infrastructure, change their governance system. And it is measurable. There are a number of public indices that you can use to measure improvement before funds flow. I think the last point is, there are, the dysphoria channel an awful lot of funds to specific countries. And I think the G20 could easily set up a global fund for investment in infrastructure projects in emerging markets. That way, I think also, taxing the wealthy more, taxing some of the polluting industries more, to channel those funds into sustainable infrastructure investment. You kind of get a double return on your money if that can be done. And I think that's becoming more realistic now.
And do you think in this case, Professor Matthews, engaging or put a conditionality on such government fund to engage in developing countries to have more private sector with them? So this will first reduce the rate of return needed, as the government, most of this fund, let's say it's for development purposes or an aid. The second, the engaged or conditionality of to have a private sector to fulfill the rest of the fund will engage the private sector and put this kind of conditionality that you just mentioned, which is not easy for the government set. So it's become any aid or given to developing countries or less developed has, and it's a conditional to have a private sector part of the fund.
In many cases, studies have shown that governments trying to design a role for private funds actually ends up not accomplishing that objective. It tends to be, the government cannot structure what private sector wants. Private sector needs to do that. But private sector needs to be brought in as a player on a, you know, just as we are sitting around now, or when I'm in Saudi, we sit down on the ground on a carpet and we talk through problems and we find and learn each other what each other's concerns are. That kind of simple, you know, done in a more formal manner. We don't have to sit on the ground, but it gets everybody at the same level so they can talk about the fundamental problems and private sector can say, government, here is the best way to open the door to private funds. And that's not being done now. That needs to be done. And it's not lecturing. It's not conferences. It's very simple representatives of, there are so many different elements of private asset classes that would be available for infrastructure funds. They're not well being tapped right now.
I think here, John, you are touching on a very, I would say, sensitive issue, because in the past years and especially in the past decade, ever since the global response, especially by the G20 to the global financial crisis of 2007, 8, 9, we have constantly heard that there is plenty of capital which is theoretically available, right, worldwide, and especially private capital, and that it could be or it should be invested into development projects or into infrastructure projects, but there are hurdles and there are problems, and it is gridlocked and it is not being invested at a sufficient level. And as Raja has recapped also in the beginning of the conversation, there are the needs to cover infrastructure investments needs globally are by the trillions, especially in emerging markets. So my point here would not be to say private sector investment in infrastructure systems, such as private equity and other sources, are not important. But for me, the key question is not this one. The key question is, why do we have, since the last 10 years, persistent hurdles and global inability to make sure that this theoretically available capital is being invested in the infrastructure systems that are needed globally? And here, the problem is not the availability of private sector capital. The problem is return on investments, and the problem are risks, and the problem is transparency, and the problems of corruption, and the problems are also the fact that, and it was well stated, including in your opening presentation, the problem is also linked with the fact that so far a number of, I would say, private investors did not believe that investing in infrastructure would be the best way, right, to sustain their fund or to sustain their business in the future, facing so many risks, especially climate risk, environmental risks. In that regard, I think one dimension of future infrastructure systems, and also one way to boost private sector investment and channel this funding to the locations where it is needed the most, would be also linked to what MDBs, what the G20, what international finance institutions, not the private sector only, can do in reinforcing the case for sustainable infrastructure investments. And I think here that is something which is highly critical, to turn what was perceived as negative values, climate risks, etc., as the only options for the future, to move from, I would say, traditional infrastructure investments for growth to infrastructure investments that can sustain sustainable growth, right? So the parameters of these global infrastructure games, I think, are changing, and the question of private sector investment availability is one aspect, but in a broader picture, where the question of sustainable infrastructure is so critical, and might also be a way, right, to reconcile private sector investors with infrastructure investments, especially again in developing and emerging markets.
Yes,
I think you raised some very good points. And one thing you might think about, if you have an apple tree in your backyard,
I have one.
you don't have to look very far to get good apples. And I think, particularly in the area of private investors, the focus was my backyard has an apple tree. I don't need to go anyplace else. But that apple tree now is being exhausted, because private investors have invested in a lot of apples and picked them, and they're gone. And so now their perspective is becoming more global. The other factor is the wealthy sector of society has grown tremendously in the last decade, in the last two decades. Those funds are looking for investments. They are looking for investments. A lot of the source of funding in the private sector today comes from very wealthy people who have been innovators, have led economic growth with new technologies, and other investors that have supported all the other industries that they need to take advantage of those new technologies. So that concentration of wealth is looking for opportunities. And that means that I don't only need to look at this now skinny apple tree in my backyard. I want to look much more globally. So the return may not be exactly as high as I want, but I'm willing to take, more willing now to collect these funds and take it. If you look just private sector, private equity sector, one small piece of private funds available are in private equity. And if you look at this, they're holding about $1.2 to $1.4 trillion in cash in the bank or in callable capital. Do they have investments for them? No, otherwise they would have invested it. They're looking for investment. Now that's a small amount compared to the 40 trillion that may be needed in infrastructure. But that's only one sector of the private sector. There are insurance companies. There are, look at, the appetite for risk. Think about some of the hedge funds and how they have behaved and taken on risk, not always winning, but have put massive amounts of funds into investments in higher risk opportunities. So I think the capital, stock of capital is growing, supported by an increasing wealth of the 1% of the population. The emergence of higher risk appetite investments is growing, and there's because of the exhaustion of the backyard apple tree, there's more of an interest in going global. And as I mentioned before, infrastructure investment is a nice, stable return, immune from some of the adverse effects of financial crisis or things like that. So it is an alternative that is opportune. And it also represents the chance for private funds to do something for sustainability, to reverse climate change, to improve where their funds go. So it helps to reduce that image of barbarians at the gate. We're helping to build the global economy by investing in these infrastructure projects that reduce pollution and change our use of acids that affect the climate around us.
I think you also agree with me, Professor Matthews, the importance of avoiding the monopoly or oligopoly on this case on a private investment in infrastructures, as some of these infrastructures end up such kind of an investment of it is a natural monopoly. So if there is no right regulation, so we will not let the private sector do whatever they want to do or give them whatever they want, but to put this kind of regulation, avoiding the negative impact from transferring the investment on infrastructures from public, who, as you know, maximizing the welfare of people, to private sector who maximizing the profit. Whereas if they have the opportunity, they will transfer it to such kind of a monopoly actions and prices. And in this case, will have a negative impact. So I think you agree, we need a minimum regulation to avoid, to go to this direction.
Yeah, you raise a very interesting point, Dr. Raja, and this is the concentration, problem. We used to think of the problem in just major industrial countries, concentration, monopolies, oligopolies. It is becoming more of a global issue. And I think we're beginning to see that issue, at least here in the United States and in Europe, it's being raised. I don't think I have a solution yet, but the other part of that is, sometimes it's costly to break up a company, and it's less costly to invest in innovation and create an environment for innovation. And we're seeing some of the grassroots effort in emerging markets of that happening. But the focus on investing in education, of encouraging people, workers in developing countries to upskill their needs. I mean, if we put smart technology infrastructure in emerging markets, somebody's got to operate this technology. And right now, that may not exist. So there's opportunities there. That is a shortfall, that the country can focus on, do something about, and it takes a while to do it. So the sooner they get started, the better. And that investing in new industries, new innovation. I mean, we are now at the launch of a new innovation decade with the fourth industrial revolution. There are so many opportunities coming forward that it's a chance to invest in more new innovative startups. And that will, by its nature, de-emphasize the monopoly that exists in some of the 5 big technology companies right now.
Good. Thank you so much, Professor Matthews, for these introductions and also the dialogue and answering some of these concerning questions. I know fostering private sector investment in infrastructure is not an easy topic. It has a lot of details on it from different angles. So I think we covered, as you just mentioned, many issues either in policy papers or in our task force statements. So thanks. It might be time to move to the second topic, enhancing infrastructure efficiency, where I would like to give the floor for Nicholas to give introduction for 5 minutes. Please, the floor is yours.
Thank you, Raja. So I'll try to circulate here with a little bit of a different perspective and share something I've prepared, just a couple of illustrations. Is it okay? Can everybody see the screen?
Yes.
Yes, okay, thank you very much. So this is more a series of snapshots of an understanding of upgrading infrastructure efficiency. This is sort of the very typical background of what we are talking about, right? Regarding infrastructure investments as one key backbone of global growth. and supposedly also well-being, with an acceleration, especially in the past 30 years and even furthermore in the past decade, right, of interconnectedness worldwide, and issues regarding logistics and supply chains, or regarding road infrastructures, or regarding maritime infrastructures, or regarding IT infrastructures, or regarding energy infrastructures. We can see that we are completely cross-boundary. It is connecting the whole world, of course. It is connecting even more the wealthiest part of the globe. And the issue of infrastructure efficiency has been part of this globalization development, which has been supported. And I think here, John, one way also to tackle the issue of the role of private sector into infrastructure investment is here. The background is not just infrastructure development, infrastructure for growth, advocacy. It's also the fact that when we are talking about infrastructure development, we are talking about urbanization, right? And we are talking also about cities. But so far, even throughout the G20, I would say, furthermore in the T20 or in the infrastructure working group, the issue of cities and the issue of infrastructure investments have been completely disconnected. To put things even more, I would say, bluntly, cities have not been part of the equation of the global approach to infrastructure investment, which have been more an issue of macroeconomics, an issue of standards and regulations, an issue of meeting climate change, but also globally, and of connecting dots worldwide through, again, logistics, supply chains, and trade and commerce, and etc. But regardless of the fact that those infrastructures are not being developed for the sake of it, right? They are connecting people, they are connecting places, and those places are cities, and those cities are in agglomerations and metropolitan regions, and those regions are often, be it like, for example, in Japan with Tokyo, Osaka, in China, in the US, in India, or in Europe, in sort of designated mega regions, or large scale or mega urban corridors. And the whole thing of upgrading infrastructure efficiency, if now it is not incorporated into an overall approach to urban efficiency, which cannot be just about GDP growth ratios, or refining these technological systems regarding the management of power grids, and etc., but including aspects of social inclusions, including the development of social infrastructure. If this is not becoming part of the equation the right way, I think there will be a growing disjunction between, on the one hand, spheres of expertise and finance regarding infrastructure investment, and on the other hand, to oversimplify the equation, I know, the people. We have seen during the COVID-19 lockdown, global lockdown, very significant changes in the environment and air pollution. They were very momentary and not long, but these illustrations, this one, for example, these photos, which were from the NASA Air Observatory from February, comparing before and after the lockdown in major Chinese cities, and the consequence on air pollution. On the right-hand side, you can see air pollution has practically disappeared. You can find it in all languages, in French, in Korean, I don't know, in Chinese, but you can find it all over the place. And whether you are in Argentina, or you are in Europe, or in the US, or in Southeast Asia, whatever, it feels immediately familiar. And this aspect of the COVID-19 playing as an exemplary role in rethinking the role of infrastructure systems is also something that we do need to take into account while we address the issue of infrastructure efficiency. Of course, addressing infrastructure efficiency deals with also rate of returns, of investments in infrastructure. And again, all this background of global infrastructure investments, either nationally through the support of international financial institutions, the MTBs, or even with the private sector. But now the equation is changing. And Dean Sonobe has insisted very much, and I think also very wisely, building on Dean Yoshino's approach to spillover effects and so on capacity building for the management of the infrastructure system. But here we have something that is even more consistent, I think. In increasing infrastructure efficiency, if it is not increasing, I would say, the green efficiency of future infrastructure systems, is a waste. In here, there is this graph you might have seen already from last July, analyzing the green impacts, that is the way that climate change, especially in GHG emissions, biodiversity a little bit less, are being taken into account into recovery packages that have been engaged throughout the different countries of the G20. And you can see that, alas, in a number of countries, this question of green recovery, taking into account resilience, taking into account climate change, taking into account biodiversity, taking into account those major challenges, have not been so much of a priority. Of course, this can be discussed widely, but this is an interesting indication of ongoing debates, which you can see and you can witness politically, not only globally, but also nationally. And I would say one aspect and one recommendation of our task force on infrastructure investment and financing should be to tackle infrastructure efficiency, including these social and environmental aspects. The last point I would like to insist on very briefly is a couple of recommendations. In the last year, during the T20 and G20 Japan, the issue of quality infrastructure investment principles has been very strongly brought up, supported by ADBI, supported by the T20, and it made its way through the final communique of the G20 in paragraph 13. And it's really a breakthrough in, connecting the sort of very global layer of infrastructure investment debates with something which is much more tied up to what has been perceived as being local up to now. But this local, which is basically this urban world, is not so much local, but also part of this global infrastructure of cities that we have. And our recommendation here would be to really build on these quality infrastructure investment principles, but move one step further and have a quality and sustainable infrastructure investment principles to enhance infrastructure efficiency, not just financially in the short run, but also financially in terms of green, socially, environmentally sustainable growth in the midterm and long term, with three elements: inclusion of nature-based solutions as an engineering and financial component of future infrastructure systems, considering the role of cities and the impacts of infrastructure investments on urbanization by adopting a multi-sectoral system approach, including well-being and health, and a review of how the private sector can contribute to shaping more sustainable infrastructure delivery, including job generating and resilience perspective in the COVID-19 crisis context. We have developed a number of more detailed proposals about that. But in any case, what we do recommend as the T20 and as a co-chair here of the T20 is that the G20 infrastructure working group, that is the ministerial group of the G20 discussing about infrastructure systems, include now or develop a systematic and multi-scale review of nature-based solutions through the infrastructure cooperation platform, especially in the post-COVID-19 context. Why nature-based solutions? And why bringing here the issue of natural capital is because we do believe that the sort of infrastructure for growth model that has been prevailing globally in the past 30 years still is very much valid and has contributed to growth, undoubtedly. But we are reaching its limits when we see the impacts on climate, when you see the impacts on biodiversity, not just locally or in pockets, but also globally and in interconnected ecosystems, meaning that whatever happens in the next 30 years, and it has to start now, reshaping infrastructure and rethinking infrastructure investment efficiency has to take into account sustainability in an unprecedented manner. And we believe that it has to be a matter not just of ecology, but a matter of macroeconomics and regulations.
Okay, thanks, Nicholas. I think what you touch on is really important issues, and if you add to it what the IMF mentioned about the loss of resources, as they pointed out, the amount of resources that's spent on creating and maintaining infrastructure, about a third of it in globally lost, and in case of developing countries, more than maybe 50%, which will create also distortion on the economy and maybe affecting even the rate of return on the other sectors on the economy, as we've been seeing in different places, specifically in developing countries. So to tackling the inefficiency and enhancing the efficiency of investing in infrastructures is really important for many aspects. So I'd like to open the floor if there is any comments or questions. Yes, Professor. Yes, Professor Boucher.
Okay, it's a very nice presentation. I have two comments. First one is efficiency of infrastructure is sometimes very difficult to compute or measure. Cost-benefit analysis, or as you mentioned, that maintenance cost, repair cost will come later. And politicians prefer their own bridge, their own road to get some popularity. So there's a long-term perspectives to look at the efficiency and cost and benefit analysis. And I hope we can construct those kind of formula so that people can look at longer perspectives rather than short term. Second comment is about the COVID-19, this pandemic. Urbanization, infrastructure that relates to all our task force would to make some changes in the traditional way of thinking about infrastructure. Many people will work from home. Then existing infrastructure may not be so much needed compared to the past. So what do you think about those changes after COVID-19? Those are the two major comments. Thank you.
Rasha, shall I answer now or give a couple of comments?
Please go ahead. Yes.
To Yoshino, or yeah?
Yes.
Yes, regarding the COVID-19, I think we are still collectively trying to assess all the impacts on infrastructure investments, because typically those are long-term investments and they are not. And in a number of situations, they are already being revised. For example, in New York, a new metro line, which the financial models was based upon future user fees, has been suspended, right? Because we are seeing a very significant drop, and which might be a long drop into passengers in public transportation. And this might be happening also worldwide. So far, I would say the assumptions that the COVID-19 crisis will have positive impacts in reshaping infrastructure investments and driving more investments into green or more sustainable directions are absolutely not granted. It might even be the contrary. When you need to support entire sectors of the economy, such as, for example, the car industry and others, these are very difficult choices to make. Furthermore, I would say, one aspect of infrastructure investments in this COVID-19 context is that the nexus or this connectivity between infrastructure investments, sustainability, and long-term growth perspectives is being readdressed and being widely discussed. And there is no new doctrine which has already, I would say, emerged globally, which would easily pave the way, right, towards good choices either at a global level or good choices at a regional level. And this has to be done. This has to be sharpened. This has to be shaped. And here I think there is a specific responsibility. It was also mentioned by Dean Sonobe in his opening address, of think tanks and of places such as the T20 to dig deep, openly into the issues and understand how to shape really these, how those long-term pathways can not only be invented, but also implemented. These would be a couple of remarks after your note on COVID-19.
Yes, Novel. Go ahead.
Yes, well, congratulations, Nicolas. I could not more than agree with Nicolas' presentation, since I'm a co-author of the policy brief with the group of other renowned authors. Well, I completely agree that we need to strengthen the quality infrastructure principles, G20 quality, by broadening the role of nature-based solutions and ecosystem services in achieving the delivery of infrastructure solutions. The question I like to ask to I don't know, this is a difficult question, but a moment ago, John referred to the possibility, for instance, of taxing polluting activities, whether in order to introduce the economic value of ecosystem services in decision-making, payment of ecosystem services could be stimulate the production of positive externalities and could be considered as an alternative. Do you think, not in all contexts, but particularly in developed country context, payment, do you think payment of ecosystem service could be also an alternative to introduce the value of these in decision making?
Yeah, thank you, Beatrice. And this is a very important topic. What I do believe, and if there are questions or if there need further explanations, please share your insights or your questions in the chat, and we will answer that. Is that the quality infrastructure principles, and furthermore, quality and sustainable infrastructure principles could be an accelerator of time to market policies, both on land and on sea. At this moment, the monetary and non-monetary valuation of the benefits of natural-based solutions and ecosystemic services has still to be strengthened. And things should go both ways. Things should go from a macroeconomic perspective. And this is typically an arena for the G20 itself and for the infrastructure working group, with all the strength of the international financial institutions and global players, be they public or private, which are participating, about the valuation of natural capital and about the macroeconomic potential of ecosystem services. In parallel, and at the exact same rhythm, there should be a very pragmatic approach to tackle, I would say, the most impacting or the most significant infrastructure systems. I'm thinking here about very simple one, roads, right? Or linear transportation infrastructure, be it roads and railways and others. And what we can see is that we start having approaches, including financial and geoengineering approaches, which build on sustainability, resilience, which take into account impacts on biodiversity at many scales and on the emissions of greenhouse gas, but on the other hand, which also try to build on economic models such as through global performance contracts and mobility corridors with aspects on investing in those corridors and remunerating the spillover effects at a wider scale. As for C, be it coastal infrastructures, be it ports, be it the so-called blue economy, we can see also a number of initiatives which are not just localized, but which are really multiplied, reaching out to global transformation potential that could be developed along a stance of sustainable infrastructure. And this is, I think, a much needed transformation from, on the one hand, macroeconomic approaches, and on the other hand, just a local or community aspects, to elements of interconnected systems with ecosystems and the valuation of natural capital in the middle, where there is much room for improvement, again, against taking into account the fact that in the next 20 years, 10 years and 20 years, be it in the developed countries or at this moment in emerging and developing countries, we will have to deal with even more urbanized contexts.
Thank you.
Any other comments or questions? I think it's a good time to move to the third topic.
If I may just, if you give me one minute, dear Raja,
Sure.
I would just like to also insist on financial enablers to implement those principles. It's useless now to bring out big principles or an additional sets of principles if they are not being supported by the right financial mechanisms and enablers. And I think John could only agree with that. In this regard, sustainable public procurement would be clearly a way to move forward. Reconsidering also partnerships between the public and the private spheres, building on global commons and common interest, and of course the development of payment for ecosystem services as such could be also developed, and then there are examples of business improvement districts which could be turned into livability improvement districts. Those kind of principles should be used and could be developed widely, especially building on the, I would say, first generation of spillover effects and land trust that has been brought by Dean Yoshino, and the second generation of this land trust and spillover effects backed by reinforced human capital that Dean Sonobe has been introducing. We have, I would say, the bits and pieces of a puzzle to, I would say, restore infrastructure investments as not just for economic growth, but for economic growth within the planetary boundaries. I think this is very important.
Yes, I agree. I think also we need to distinguish between the two parts here. It's one about the efficiency of public investment in infrastructures to be its more efficient way that will value each dollar has been spent in infrastructures. The second point, I think, which now with the COVID-19, we might a little bit move away from the efficiency of infrastructure itself. I think now we're moving from efficiency more efficiency to resilience. And I think one of the topic which we will cover later on with Shamshad is about this issue, the spare capacities in infrastructure, which is a little bit against the efficiency of infrastructure itself. So I think we need to not to mix these two issues, as it's really important to tackle. Of course, the public investment, the efficiency of public investment in infrastructures, if it's not inefficient, and is it like what the IMF mentions, a lot of money lost on the way of building or maintains, then this will have many negative impact that we try to avoid it, and will increase the risk and increase the rate of return. Okay, then I think it's good time to move to also the third topic, which is more related to this issue, how to maybe solve the inefficiency on public investment in infrastructures. Basically, this one will be about the infrastructure accountability and transparency. And happy to invite Shamshad to give keynotes about this topic. Please, floor is yours.
Okay, so everybody today is talking about resilient recovery, but how will it emerge is the big question. Of course, it's synonymous with the quality infrastructure. So all the debates we have had are very pertinent. But at the same time, we need acceleration and enhancement of sustainable and of course green infrastructure, which has to be reinforced with innovative finance architecture, which includes new instruments, but also it has to include different modalities. And one of them, Yoshino, has been articulating for a long time. There has also been an echo on the strong governance. And together these generate, of course, the synergies for recovery, because we need recovery of jobs, we need enhanced productivity, we need inclusive infrastructure for societal benefits. Now, what is the real story? On supply side, if you invest 1% of GDP in sustainable infrastructure, not infrastructure, then economic output is much higher, 1 to 1.5% over the 5 years or half a decade. And it generates an increase in investment. The requirements that we need today is that we have to move from 2.7 trillion in 2020 to about 15 trillion by 2040 cumulatively, which means we have to every year add 3.6 trillion and 4.6 trillion in the later years. This is almost doubling the game of annual funding that has to be deployed. So what is the storyline today on the finance for resilience recovery? UNCTAD has estimated that developing countries' debt service repayments on their public external debts alone will cost about 2.6 to 3.4 trillion in 2020 and 2021 alone. And market analysts now suggest that almost 40% of emerging and frontier market sovereign external debt could be at risk of default in the next year. So what is my first recommendation? And I will get to investment efficiency tying up with this argument. First of all, we in the United Nations have been arguing a lot that the debt relief that G20 is providing is welcome. But how much is it? 11.5 billion, and there is now a talk, you may know better, but basically everybody is articulating two things. One is multilateral debt and private creditors' debt need to be a part of the debt suspension service liabilities. Second, that it needs to extend from these little countries to low income, middle income, and emerging markets. That's the only way that we can get infrastructure really restarted. And the idealistic talk that we have had requires much more money out there. So that's why I like the idea of the global infrastructure funding mechanism. We can put in more details and teeth to it, but that is why we need private sector involvement, we need pensioner funds, and we need other institutional investors' money out there to be able to come forward. But believe you me, with the debt vulnerabilities that exist today, unless there is some kind of further substantive relief, it's going to be very difficult to move into resilient recovery, simply because the G20 relief currently is limited, it is hurting the prospects for investment in infrastructure, in middle income and emerging markets. So to boost infrastructure, which is critical for growth, and also to bring debt sustainability, it is critical to do few macroeconomic adjustments. Of course, we have already adopted easy monetary policy. It is going to support the low interest rate environment. That's one macro measure which will allow us to offer some space, so to speak. We have to expand the scope of the debt relief to developing and emerging markets, get the MDBs, private creditors to extend debt relief. We know that the World Bank has said, well, the private sector should come forward, but no multilateral wants to sacrifice their preferred creditor status. And most of the African debt, the really vulnerable ones, are really private creditors' obligations. So we are locked into a situation, and we had a lockdown. So we lost, the revenues have shrunk, and fiscal stimulus is at a historical level. Government borrowing surged, as you pointed out also, as G20 debt relief is limited. IIF says that it's today global debt is about 330% of GDP, not 200, it was in the previous years. So we are hurting the prospects of investment in infrastructure in middle income and emerging markets. And of course you need infrastructure, but you need different type of infrastructure. Post-COVID, as has been pointed out, we need digital infrastructure, we need inclusive infrastructure, because the way we do business is going to change. We have to also diversify financial markets in the low-income, developing and emerging markets. We are always talking about developed countries, but look at the situation as to what is the size of the private capital markets in the low-income countries and developing countries is very limited. So promoting investment efficiency, to me, is synonymous with infrastructure quality, and it's been a theme of G20 now for a few years. So it is critical for a sound recovery of global economy, and it reinforces quality, sustainability, and resilience. So they back up each other. Now, what is more specific on investment efficiency over and above what has been talked about? It requires, as you were saying, Raja, that it requires systems thinking in midst now of uncertainty of COVID-19 and other pandemics that are to hit us in future. And investment efficiency is needed to prepare for future, has to be tackled to prepare for future risks and demands. So what do? We have to do integrated infrastructure development framework so that the cost is effective. It promotes sustainable, climate-friendly, and technologically advanced buildings. Emerging innovations have to be integrated, and we have to transform the way we design, build, and manage infrastructure systems to be cost-effective. Now, I was reading the World Economic Forum report. It suggests that low and middle income countries alone could see a net benefit of about 4.2 trillion because good infrastructure could generate almost $4 return to $1 spent. And it could be even more, frankly, if you did empirical analysis for the low income countries, as I see. So low, middle income and emerging markets alone could see a net benefit of this large context, which can then be redeployed in the recovery pandemic funds or whatever we develop. Now, I mentioned about the ESG and green financing. I do believe there's a lot of money out there which is waiting for projects to be ready that qualify this investment efficiency requirement, which is to do with climate friendliness, and we have talked about it, the ESG financing, and most of the pension funds and some of the newer ideas at the stock exchanges are that actually bring ESG funds, and we will bring in more responsible investment. We have to recognize, of course, the broad range of project risks and factoring, of course, upfront these risks in investment decisions and having mitigating strategies upfront for such risks. It has been said in so many words by a lot of people, but I'm trying to bring in precision in the wordings. So what does that really require? Recognizing project risk, factoring upfront risk, mitigating strategies upfront, developing. So we have to recognize that investment efficiency calls for financial sustainability, because if you don't have funds in midst of what you're going to do, you'll have more cost overruns. So financial sustainability through cost-effective and innovative financial structure. We do need more analysis for all this, and particularly the implications of the sovereign, corporate, and private debt today, which make it almost impossible. Without debt sustainability, you cannot have project finance sustainability. And a lot of the corporate sectors are highly leveraged today in the middle and emerging market countries. It's scary when you look at the debt. Of course, growth will help a lot to improve the debt sustainability. And that is why we all are reinforcing the point that recovery has to be accompanied by green growth or sustainable growth, so we are able to prevent future disasters which will be bigger than the COVID disaster today. A second element is the technological sustainability. So one needs to develop right technological designs at the project stage level, which should today withstand the fast disruptions that are happening from emerging technologies, as otherwise it could turn into a stranded assets already. So we have to try to explore emerging innovations in projects, sectors, to avoid making business model obsolete as soon as they are integrated in investments. So we have to integrate in anticipation of the future dynamism of the frontier technologies, how these technologies can change the design, construction, and operational phase of the infrastructure assets. How will it help us lower the cost and improve the functionality of the projects? I am fascinated by an experiment in UK that is going on, which is to plan to adopt a national digital twin program to connect all aspects of infrastructure system onto one secure network. So digital twins are computer models that combine artificial intelligence, analytics, the cloud computing, 5G, renewables, so on and so forth. This helps to optimize the planning and operation of infrastructure to eventually contribute to investment efficiency. And UK has estimated that it could bring in £7 billion of value in a year from the cost saving and efficiency gains. My last point on investment efficiency is that we need future proofing of projects or life cycle sustainability of projects. Are procedures and funding in place to guarantee the intended design for the assets that can be maintained in the future? What are the plans to manage a project's aging, dismantling, or replacements, and so on and so forth? And the procurement points that you mentioned have to be also factored in the investment efficiency besides corruption. So I'll stop here because other elements have been discussed by others. Over to you, Raj.
Thanks. We'll open the floor for any additions or comments or questions. Yes, please.
As I would say, as usual with Shamshad, it's a fascinating journey and overview within the arcans of I would say, infrastructure investments in the world as it is, right? Not as it could be or as it should be. Clearly one aspect which Shamshad, you mentioned in the very beginning, that is the level of debts, if I am right, in developing and emerging countries, right? Topping 2 trillion this year and next year is of a factor of more than 100 as compared with what the G20 has put on the table regarding debt relief, right? If I am not miscalculating, meaning not that the G20 is not addressing the issue, meaning that we are really dealing here with a massive situation. I have no clue about how this situation might be in 5 or 7 years from now, right? But however, there is I would say 1 or 2 years, 24 months framework, which is now hypercritical, right? We started thinking about infrastructure investment and financing perspectives from a sustainable point of view in the autumn last year, in the beginning of the year, and then came the COVID-19 pandemic, including a number of disruptions. And we started to include those parameters in the approach, but probably, and as also recommendations and statements, you mentioned that, Raja, in the beginning, the statement of our task force for the G20, I think should critically enhance the fact that even when we are talking about long-term perspectives, the next 24 months, and Shamshad, correct me if I'm wrong in assessing that, it might be the next 12 months, right? Or the next 3 months. But I would say the next 24 months, continuing the work of the T20 Japan and Saudi Arabia with the T20 Italy and then in India, will be absolutely critical in not misunderstanding the financial availability of future infrastructure finance according sustainability rationale, according valuing the role of private sector investments, but also taking into account those macroeconomic aspects. And this is why I was recommending and insisting on how issues such as sustainable infrastructure or the valuation of natural-based capital and etc., or even aspects of infrastructure in an urbanized context can be part of more macroeconomic approaches. Otherwise, we will keep on having, sophisticated design and models and proposals here on the one hand with, I don't know, floating cities or a super high-end infrastructure system on the one hand, and on the other hand, those modern features reaching out to the best infrastructure standards will not be able to apply or to comply with what is on the ground in a large proportion of the regions of the world. So I think here we need maybe to add something as a preamble to our communique statement of the T20 and share that with the infrastructure working group and the wider community.
Yes, I think whatever you say is actually quite consistent with what I have been saying. Of course, we have to think big in infrastructure. We have to think of innovation in infrastructure. We have to make sure the macroeconomic environment and financial stability pre-exist, because they are prerequisites for infrastructure investment in any environment, be it the advanced countries or developing countries and low-income countries. With so much of the money that has been used for fiscal stimulus today and for social relief, what is left on the ground for countries to invest in infrastructure is actually very limited. And a number of projects are happening, but a number of projects are getting postponed. And of course, sustainable and climate friendly. I mean, this is reality on the ground that I'm telling you. A number of projects are getting postponed because of the lack of available funds. Now, the debt relief that has been provided to a segment of countries, 73 in number, but availing parties are only 23, 25. What happens to rest of them? They have exposure to the private creditors. So they are worried about their rating when they go forward to borrow more funds. So ultimately, we have to look at the financial sustainability. And one of the things that we have been proposing to G20 through another platform is to possibly consider linking debt relief, which is a very important source of funding, for 1 year and extending it, of course, 2 years or 3 years, whatever is affordable and can be negotiated amongst the members, but directing this for sustainable development goals, particularly for eco-friendly and nature-based solutions, because that's going to hurt us more. And the concept of debt swap facilities has also been floated. The issue is not that we don't have debt swap facilities today, but their scale is very limited and they are very costly propositions in the way they exist, because they are happening on a project basis. So if you pool up the funds, and as somebody was saying, well, hand it to the multilateral banks as a repository, create a trust fund, and let countries that come up with high quality, responsible investment to draw on that fund for the debt swap in exchange for climate adaptation and mitigation. So the money is available. Now, okay, you know, the advanced countries can tap their institutional investors, but ask me, what is the size of the institutional investors at the local level in the developing countries? You can really see it's minuscule, but of course there are better countries like Malaysia and others, but there are countries who don't even have an institutional investor. So expecting United States pension funds to invest in these countries is expecting too much, as you were all pointing out to the risk proposition that exists today. Lack of readiness of the projects, the corruption issues and all that. So if we have project readiness facilities and we have an assurance that the relief is going to be invested in circumventing the future crisis. After pandemic, the new crisis is the crisis in waiting. It's not new crisis, it's happening. I can tell you, we have had massive floods in Karachi. So I can relate to Nicholas' point about the need to have urban infrastructure address ASAP. But somebody was saying, you know, what type of, I can tell you, water supplies, sanitation, flooding, prevention. You know, there's so many things that require money. Federal, provincial subjects are very complicated. So you really need to work at local government level to generate funds. That is why I was saying, suppose you are a local government and you want to apply for a climate mitigation and adaptation funding. Where do you go today? Municipalities don't have the balance sheets to do that. How are we going to fund that? So I'm just speaking from the ground, practical, and I think investment efficiency elements that I pointed out is based on the lessons learned that we have. You start a project thinking big and the failures after failures. And if you have, when you had COVID, you had interruption and there were costs to those interruptions. So imagine when climate crisis hits us in a bigger way than what it has happened. Right now it's localized. What would be the situation then? And what would be the major losses? That's what COP26 is going to be looking at. And there is already a big debate on how do you manage the climate adaptation, but I know we have a separate task force for that. Okay. But from infrastructure point of view, I think climate adaptation and mitigation, resilient infrastructure is critical.
Excellent. Thanks, Dr. Akhtar. It's really an important points and issues that you raised, and it's for sure is reflected in our task force statement and on some of the papers. And thanks for bringing the ground to more practical idea. And now I want to move to Professor Yoshino. Please, the floor is yours to give introductions about the topics in infrastructure accountability and transparency.
Okay, thank you very much. I would like to share my few slides. Can you see my slides?
No. Oh, yeah.
No?
Yes. Okay.
Oh, okay. I hope you can see my slides.
Yes.
Yeah, yes.
Okay, thank you. I think in order to reduce corruption, transparency, major infrastructure, especially in developing countries, should be part of the money come from multilateral institutions, MDB. And they can be a watchdog for the corruption and also the performance of the infrastructure. And together with long-term investors, private insurance, and also pension funds, and long-term and patient investors are required. And next is that how do we know the performance of infrastructure investments? Many multilateral institutions often ask survey how much it had helped their welfare and so on. I think it is very important to look at the impacts of infrastructure investment. And one of the ways is to look at growth, GDP of various regions, agricultural sector, manufacturing, services sector. And then we can also look at the changes in tax revenues, whether tax revenue has increased only in rich region or all over the countries and so on. So I think the performance and disclosure of the impacts of infrastructure investment will make the transparency much, much better. As Dean Sonome was talking about, infrastructure, good infrastructure will increase huge tax revenues, income tax and corporate tax. I think those disclosures of the impact of infrastructure investment will be quite important, especially in developing countries. So measures of the impacts of infrastructure can be seen by GDP of various sectors, sales, and tax revenues. However, in many developing countries, many people do not pay tax as it is promised. And then Finance Minister of Philippines is now thinking about using satellite photos. Agricultural farmers, they have lots of trucks in the fall. Then they can count all those trucks in the restaurants, how many people, customers are using it. It can be all shown by photos. And that will drastically reduce the tax evasion. And then those accurate tax data can talk about the impact of infrastructure investment in various regions. Another one is individual data. In Thailand, many people use credit cards. And if those data can be accurately collected, then the impact into the individuals by infrastructure will become possible. So I think the transparency of the impacts of infrastructure investment in many developing countries are important. In order to do so, we often talk about infrastructure as railways, highways, water supply, but internet, digital infrastructure will become also very important to assist. Furthermore, digital infrastructure has very low rate of return because they rely on user charges. And again, many people do not pay for those user charges. So I think spillover tax revenue can be returned to digital infrastructures so that digital infrastructure can be transparent and also penetrated to many regions. And as far as corruption is concerned, in many Asian countries, land acquisition is one of the most corrupted part of the infrastructure investment. About 30 years ago in Japan, politicians purchased all the land where the road was planned. And then he has gained enormous amount of money. So I think land trust and purchasing of infrastructure and land purchase, those transparency will be very important. And if land trust is used, trust bank will become in between landowners and infrastructure companies. So that will make transparency of the transaction. Next is the transparency of the land price in various regions. This is in Japan. It started about 10, 15 years ago. All the transactions of land can be looked at by internet, which was announced by Ministry of Construction. So that makes land price is very transparent, and one cannot charge very high price to another. And in Asia, there are lots of land mafia because land prices are not disclosed and those transactions are not disclosed. So politicians and mafia and so on. So disclosure of those land prices by internet to all over the places, that will reduce corruption enormously. And this has helped in Japan to reduce those corruptions. Last point is ESG, SDG, and green investment in relation to infrastructure investment. As John Mattis was discussing about pollution tax, based on my research, the best way to reduce environmental problems is charge tax, same tax rate to CO2, plastics, and so on, globally, same rate. Then the company, those who are exposing lots of CO2, or automobile who are exposing lots of CO2, has to pay higher tax compared to greener companies. Then the rate of return of those companies will become lower because their pollutions are bigger. Currently in Europe, green bond principles had been published. However, when I look at those items, renewable energy, that they can issue green bond. But some of the renewable energies, 80% green, 20% gray, 70% green, 30% gray. All of them can issue green bond. So that may distort portfolio allocation of investors. So it is better to charge tax to pollution by using same tax rate, then that will reduce the pollution, and also investment of the return will be automatically adjusted by those taxes. So this is just a simple diagram. Point E used to be original rate of return and risk. And then company has to pay pollution tax. Then the rate of return will come down. And last point is infrastructure funds, reserves, and trust funds. I propose the spillover tax revenues should be returned to infrastructure investors. Suppose we can have a cap in this rate of return. And if some of the infrastructure created huge tax returns, then those part of above the cap should be kept as a reserves or trust funds. Then they can be used to mitigate environment or to assist the lower rate of return infrastructures. So I think spillover tax revenue and setting the cap and above those returns could be deposited as a reserves or trust funds, so that that can be used in disaster and so on. So those are my points, and thank you very much.
Thanks, Professor Yoshino, for these points and the suggestions. I think you touch on important issues regarding the transparency and being able to trace some of the information and make it more available using the new digitals. And I think the idea of one unified taxation globally and pollutions that might affect. But of course, the other of it from economics to economics, as it's given the impact of purchasing power parity in different countries and the value of this percentage or unified percentage on company businesses and the risk they are facing. So we might need to think about this kind of a unified tax globally, given the level of incomes and the cost of doing business and the other taxations in such country to not hammer the businesses that might benefit the growth on some developing economies. But like to, if you have a different idea or any other co-chairs would like to have a questions or comments, please. Yes, Professor Mathis.
Yeah, Dr. Raj, a question, more of a macro question. For industrial countries or developed countries, Yoshino, I can see where the logic works very well. What if you go to a country that growth is dependent very much on a raw material, which is also a polluting raw material? Then does the same model also apply to that country, or do you have to tweak the model to make it work?
Okay, thank you very much. That is a very good question, because we are all thinking about developed countries and relying on automobile and so on. But that is very correct. Developing countries, you criticize coal, but many of them are using coal. It's very cheap. And it is not easy to force them to change coal into other renewable energy in next year and very near future. So I think we should set up the timeline for them. Those countries who are in developing should achieve those goals within several years. That could be mitigated compared to other countries. So I think some of the adjustment will be needed, but we cannot let them as they are doing right now.
Okay, thank you.
It could be gradually imposed instead of just only using the same form from day one. This is I think will help to solve the problem just Professor Mathis mentioned, because you don't want to hammer the growth in such country and make it a negative way or let the investment run away from them.
Yes, economic growth is important, but at the same time, regulating pollution, reducing pollution, both are the two targets. Yeah, that is correct.
Okay. I have a remark, which is also a question for Dean Yoshino. Getting back to the geography of the investment in future infrastructure systems. Recently, the Chinese president has the Chinese president has said that his country, China, would target carbon neutrality by 2060, right? For instance, how could the G20 be instrumental in mega regional projects such as the Belt and Road initiatives to feature global standards of quality and sustainable infrastructure, for instance, and similarly reaching out to the African context, how this could be also applied?
I think quality of infrastructure, we have to look at the long-term perspectives, then looking at repairs and maintenance costs and so on. And as you mentioned, the good quality will, in the long run, will benefit by looking at the present discount value. The problem is politicians' way of thinking. They are just on the 4 years or 5 years, and they prefer to construct their road in their own region. So I think multilateral institutions like European Development Bank, World Bank, ADB, that should play an important role in the checking the significance of the quality of infrastructure. I think that kind of outside view will be important. Otherwise, if it let each country alone, then there's a political distortion will always happen. Thank you.
So basically, you want to put a constraint on the politicians to move their thinking from short term to long term, which I really agree with, either through the global system, international organizations like the World Bank, or maybe introduce a new law in most of these countries that constrained by parliament or whatever there's to constrain the thinking or the action of politicians. I think the time is squeezing us. I want to move to the last topic, which is not the least, of course. It's engaging international economic organizations and enhancing global infrastructures, which is related to the last point you just mentioned. And I would like to invite Dr. Nofal to give an introduction on that, please.
Well, thank you very much, Dr. Raja. And first, I want to thank you and thank T20 Saudi Arabia for this excellent work we have done this year. And I want to thank all my colleagues also for excellent work. And I have learned a lot in the process. The G20 Saudi Arabia 2020 regarding infrastructure investment is proposing to narrow the infrastructure financing gap through improving project efficiency by leveraging technology mainly and promoting private sector participation. These two elements are key and necessary pillars, but not sufficient at this moment in time, in the aftermath of the COVID-19 crisis, to narrow the the financial investment gap in infrastructure investment, particularly in the case of developing countries. I already said why, because on the one hand, they have to, like everybody else in the world, they have very stretched public budgets, and they have to engage in fiscal support to vulnerable populations, to firms, to counteract the economic negative effects of the lockdown. But also they have at the same time experienced declining fiscal revenues because of declining exports, declining remittances, drop in tourism, and dramatic reversals of private capital flows. So, and they risk, and this is my opinion, also the same flight to quality that they have experienced in short-term capital flows. I think they risk to experience this in terms of foreign direct investment, and particularly a flight to quality in the infrastructure investment space. So what is needed before the figures we were using, at least the ones G20 was using regarding infrastructure investment requirements, are about in the next, they were World Bank figures from 2015, so in the period 2016-2040, an additional $94 trillion investment was required. Of that, current spending could, in the past, it was estimated that could finance about 79 trillion, so there was a 15 trillion gap. About more than half of this new investment requirements in infrastructure were in Asia, particularly in South Asia. Latin America was the second region in terms of investment requirements. These countries, particularly developing countries, they have a problem. They have a low level of investment, and also they have low quality of infrastructure investment. So it's very important to enhance global infrastructure. It's very important, at least in my opinion, that the G20 promotes quality and sustainable infrastructure investment as a key response to the COVID-19 global crisis, and also as a key pillar of world economic recovery and future sustainable, balanced, and inclusive growth. Already my colleagues, Nicholas has gave a sense of urgency that we have in this regard. Shamshed had referred to the problems, to the likely problems with debt servicing and the little fiscal capacity or the constrained fiscal capacity of developing countries. John has mentioned different or has made different proposals regarding the attractiveness of private sector investment. Well, I would like, and Nicholas has stressed the importance of nature-based solutions and ecosystem services when considering sustainability of infrastructure investments. I would like to complement this with 3 proposals. First is that the need for, we need more capacity of, or more involvement rather than capacity of international organizations, including multilateral development banks, to help building and deploying integrated systems planning capacity in developing countries, particularly of upstream planning, so as to consider the benefits and services of natural capital, improve ecosystem services and human health, because we know that health is related to ecosystem services, urban-rural linkages, enhanced climate resilience and energy efficiency, water and food security, etc. The second, there is another element which is very important and has been stressed out, which is the importance to lower risks for attracting infrastructure investments. Lowering risk requires developing appropriate sustainability frameworks among, also, of course, it has been stressed the importance of lower macroeconomic risks. Here also international organizations can help developing countries develop appropriate sustainability frameworks for infrastructure investment. The second element, I think, is the importance of boosting infrastructure development by integrating nature-based solutions and ecosystem services in the quality infrastructure principles and in every stage of the infrastructure cycle. This also includes other, when referred to international organizations, it's very important to include nature-based solutions and ecosystem services in COP26 and also in COP15 on biodiversity. Nicola has referred, and also I think Shamshed, the need to update domestic procurement policies and regulations to consider, to promote green investment in infrastructure and to consider nature-based solutions and natural infrastructure. Here again, also domestic procurement policies can be updated to promote efficiency and transparency. And I think here international organizations and multilateral development banks can develop guidance and policy templates for standardized criteria to include in revised procurement legislations. This is key in the case of developing countries. I have done a study in Latin America. It was published by Inter-American Development Bank regarding this. One important element that comes out of our collective T20 policy brief that Nicolas led at in this effort is that international funding streams should support deforestation-free development models and promote public and private commitments for reforestation and biodiversity regeneration. This is key, and also is key to penalize any additional increment of deforestations that should be compensated as much as 3 to 5 times reforestation to be mandated and regulated at the national level. It's also very important to move the system forward to set priority targets like healthy oceans, deforestation, like we said, free infrastructure investment, sustainable Arctic and Great North. Well, we mentioned the importance also of payment of ecosystem services, of taxing pollution, etc. so that the economic value of ecosystem services and of natural capital is introduced in economic decision making. The third pillar, which is critical, we already talked, in my view, we need at this point in time to increase multilateral financial support for quality and sustainable infrastructure investment. And for that is key to infuse additional capital in the multilateral development banks and create a global infrastructure investment bank. Multilateral development banks already have committed this year to counteract the effects of the G20 of the COVID-19 crisis about $160 billion of finance, of additional finance. So they have their budgets stretched out. We have seen that national governments also. And additional infusion of capital can go a long way in terms of contributing to the closing the financial gap. In Task Force 2, Professor or Dr. Amar Bhattacharya mentioned in one of the slides that is available on YouTube that an additional commitment of $35 billion in terms of capital infused to the multilateral development banks can increase about $1 trillion financing. Financing doesn't mean to be direct financing. It can be like expanding coverage of risks in infrastructure investment, of default, of exchange rate volatility. I mean, we're at the moment where the world has experienced, because of the crisis, particularly developing countries, large exchange rate volatility, and that's a major risk for infrastructure investment. And like Dean Yoshino said just a moment ago, multilateral development banks' involvement is critical for transparency, but also is critical to crowd in the private sector. And this is very important in developing countries because of the risk of flight to quality in the infrastructure investment space. Well, and the last comment is basically the need that everybody has stressed out to enhance resilient infrastructure development by performing assessments of climate risks and systematic resilience review in the cost-benefit analysis of projects, and also establishing enforcement mechanisms. And here, international organizations, the United Nations, the OECD, the multilateral development banks can all enhance resilient climate infrastructure development by helping developing countries perform this kind of assessments of climate risk and systematic resilience reviews. Well, the last comment is it's not a proposal. It's just if there is one element that can help us drive the economic, a healthy economic recovery and sustainable and inclusive economic growth that will help us to deliver on the SDGs, that will help us also with the national, in COP23 to deliver on climate commitments and strengthen our national determined contributions. If there is one element that the world needs to focus and deliver is on quality and sustainable infrastructure investment. And we need the steering committee of G20 to go beyond the good work that has done and try to raise consensus for infusing a larger amount of capital in the multilateral development banks so as to be able to deliver with the urgency that is required. Thank you very much.
Thank you, Dr. Naufel, for this important suggestions and also points you raised. Time is squeezing us, but I think we have maybe 4 or 3 minutes for discussions. Yes, Shamshad, please.
Just a minute, let me unmute. I wanted to compliment Beatrice for covering and providing almost a conclusion of the various speakers and putting it so well. She took all the threads from different speakers and tried to bring it together. So thank you, Beatrice, for doing it
Thank you.
and connecting the dots, because there is a lot of commonality in what we are saying, all of us. We are looking at different dimensions. There is no disagreement, as I see. We are reinforcing each other. Now, one thing that I wanted to say, this whole issue of multilateral development capital augmentation has been in debate even in 2008 crisis and now, and it has happened to some extent. I fully agree with you that there should be enhancement of the capital base so that, you know, they could do more in the fight against COVID and fight against climate. But if you actually dissect what's going on in the low income and developing countries, I think there are so many conflicting demands that World Bank faces, and with its multi-sectoral agenda, that it's very difficult for it to prioritize, you know, how to address the pandemics and how to address the climate. They do these things. And there has been an incremental share of lending to the crisis-related dimensions. But one issue that I've had, being a multilateral development bank product myself for almost 40 years, that we are doing excessively development policy support. And G20 needs to examine that, because if we invest more in sustainable infrastructure and climate action through the enhancement of the capital, then we will be laying foundation for resilience recovery, as I see. But if we let them use the money to do things like finance the non-development expenditure, if you actually, when there will be an evaluation of how the funds will be used, except for where it has been directed for health pandemic or something like that, where one can really recognize, you'll find that quick dispersing assistance, because money is fungible, is not going into infrastructure necessarily or climate fight, basically. So I just wanted to qualify that I fully support. And the second that we have been talking about, and I'm sure you are part of it, is why not go for SDR issuance in a bigger manner, also from the fund, to supplement all this and invest in some of these ideas that have been generated by this task force.
Thank you, Dr. Akhtar. I agree. I think all our discussions is connected, because we at the task force number 3 acknowledge the lack of available resources and also the inefficiencies in public investment in infrastructures, and the need to boost the private fund to close this gap. And to do so, then we need to improve the accountability and transparencies, and that's what also been discussed. Of course, COVID-19 moved us a little bit away from efficiency to resilience. And in addition to that, the need, as Dr. Naufal mentions, the international organization to be engaged on the issue and also close some of these gaps and make the global fund, as Professor Matthews discussed and mentions. So all this issue is connected, hopefully, to enable us on solving these big issues of a lack of resources and inefficiencies that exist and affecting negatively their growth. This year, T20 in Saudi Arabia, they make unique things where they introduce to each task force the art. So I think we are now stopping us our discussions panel, although it's important and it's nice, and we are discussing dynamically and lively really important issues. But we all of us, I think, excited to see what's the artist gonna give us and how they will present our work. So I would like to give the floor to Mohammed to introduce our artists to see what they have for infrastructure investment and finance. So thank you so much for the panelists. Thanks for Professor Yoshino, Dr. Akhtar, Professor Mathias. Dr. Novel and Mr. Pochard. Thanks a lot.
Thank you, Dr. Raja.
Thank you.
Art is a universal language, transcending barriers of language and time. And T20 uses art to communicate its themes and policy recommendations to all. Abdulaziz Al-Najm is a Saudi artist born in 1963. He is a founding member of the Riyadh Artists Group and has participated in many exhibitions locally, nationally, and internationally. His piece of art for Task Force 3, titled Spectrum of Memory, we will leave you with Lulu Al-Hamoud to describe the artist's thoughts on that piece. Please, Lulu. You are muted, Lulu.
You hear me now?
Yes.
Assalamu alaikum, and thank you for having me. I am the curator of the T20 for the 11 tasks. I think you can see from here the painting of Abdulaziz Al-Najm. It was such a challenge actually to link every subject to a piece of art, but I found that Saudi art is very vast. The reason why we chose this piece of art, I hope that the artist would be here, but unfortunately he's traveling, so I'm speaking on his behalf. I felt that this painting especially, which is done by oil, the artist used oil to do this painting, is very structured, very organized. It shows stability. Not only stability and organized from the outside, but it also shows the depth of feelings and belonging as well. And that all is a reflect of good infrastructure. I felt that this painting especially shows a very healthy memory of the artist. If you look at the painting, it shows people and everyday life, very stable, very happy people. It shows the traditional colors of his environment, and it shows good memories of his cities as well. Are we hearing the voice of the artist, or shall I continue? So maybe this painting shows the importance of planning and investing in infrastructure. The city is the most important thing for us as individuals. And I think the artist represents, and this piece of art represents this task very well.
Thank you.
اسم العمل طيف من الذاكرة، مأخوذ العمل من مجموعة أعمال. من خلال العمل تجاوزت التسجيل الواقعي المباشر إلى الحذف والتركيب من خلال الذاكرة المحمولة المجتمع والحياة البسيطة الواقعية في القرية. طبعا اللوحة تعتبر جزء من الاقتصاد، فعند الاقتناء يبدأ تداول اللوحة للمقتنين. كل مقتني يحب أن يجمع أكثر عدد من الأعمال حتى يكون لديه مجموعة كبيرة ينافس بها الاقتصاديات الأخرى في مجال الفن التشكيلي. الاقتصاد الثقافي هذا يعتبر من أهم البنى التحتية في الدولة، دائما تنمو بنمو أبنائها ثقافيا وفنيا واجتماعيا. بدون أن يكون هناك نمو ثقافي فلا يعني أعتقد أن حيكون هناك اقتصاد ناجح. والاقتصاد مرتبط بالثقافة.
So, Lulwa, do you want to add something? Thank you so much. We're also delighted to welcome Franco, a scientific advisor at IAI, who will be providing us with an Italian perspective ahead of the Italian presidency of the G20 next year. Please, Franco, the mic is yours.
Yes, well, thank you very much. It was a great pleasure to listen to points of view which G20 press next year. It is not my role to present what will be the topics that the Italian presidency will cover. But I would like just to stress how the issues that have been discussed today will be important also during our presidency. We indeed will be having the role of chairing the G20 at a very, very difficult time. Of course, Saudi Arabia also had a very, very difficult moment to challenge, to manage the G20, and we greatly appreciate the great work they have done. But I mean, we will be working in a very difficult, uncertain environment in which we will still be looking at what will be the impact of these very unconventional macro policies that have been introduced during the crisis. And the general feeling is that there is not much more room for standard macro policies because they have been used to a large extent. So it will be crucial to have a focus on structural policies, and infrastructure investment will be part of this. So for this reason, the topics that have been discussed today will become even more important as we move forward. As we move forward in a situation in which the fiscal and monetary policies cannot further impress any stimulus to the economy, so it will be important that the private sector and infrastructure projects will provide particular impetus to our growth. All the issues that have been dealt with under the Saudi Arabian presidency will need to be further expanded and analyzed, from the innovative frameworks to bridge the investment gap, the quality investment, the governance, the global standards, the bottlenecks for least developed countries. These are all crucial issues that we will, the technology innovations that we will have to address. We will, however, face also some of the issues that have been discussed today in these sessions, which will become the focus of attention of the international community in the coming months, which, how the infrastructure investment will have to accommodate and accelerate some transformations that COVID has already introduced. it has been mentioned this today, the issue of urban transformation, which is a particularly important aspect because we are facing in many aspects a rethinking of how our cities have to be managed. We have all seen the importance of the proper health system, of a distributed health system within our cities, but also all the things that have been mentioned, the transportation, the social housing, all the infrastructure that will need to be rethought in light of what has taken place. So, and the issue of urban and local infrastructure is particularly challenging because the condition of public finances at local level usually are even more difficult than the ones at the national level. And so we will have to devise special mechanisms to ensure that the funds are available. Again, private sector will be crucial. At the same time, we will need to find ways to hedge the special risks that the private sector will face in dealing with local investment needs. Of course, the climate crisis has been repeatedly mentioned and will need to be further explored and addressed. The issue of inequality that has been made even more serious by the crisis will also be a top priority. And the whole system of the trade routes of medical goods, how to make sure that the health systems, there is a global collaboration in provision of the health facilities and health systems, and possibly in the future of vaccines. So these are issues that will require also a reshaping of the priority of investments. Going back to macro issues, we will still be living in a very exceptionally low interest rate environment. And so this is, it could also be an opportunity. It is still puzzling how in such an environment, it is still so difficult to channel funds to infrastructure investments when so many funds are available, and they have to find routes in the search of high yields towards more traditional sectors like equities or real estate. That could be, and not yet finding the route to infrastructure. I know this has been extensively discussed, and we will have to continue this work. It is still a puzzle why sovereign pension funds, sovereign mutual funds still invest so little in this area, and what we can do. And I think the low interest rate environment could offer a great opportunity in this respect. So what we think will be just a continuity of analysis that the T20 under the Saudi Arabian presidency has been conducted, but also taking care of the inevitable changes that the environment is imposing on us. So the main challenge for us will be to do an excellent work as the Saudi Arabian presidency. It will be very challenging for us, but we will do our best. And we thank, of course, our Saudi Arabian colleagues for the excellent work we have done. And we look forward possibly to meet personally in 2021 and not just through video screens. So thank you, and I'm looking forward to a good year of intensive work together. Thank you.
Thank you, Franco. Last but certainly not least, for this webinar's closing remarks, please allow me to welcome Dr. Fahd Turki, the chair of T20 Saudi Arabia and CAPSARC PB of Research. Please, Dr. Fahd.
Shukran, Muhammad. Thank you very much. And ladies and gentlemen, good morning. Good afternoon and good evening. It's a pleasure to be among friends. It's been a while since we met in person back in January. And I echo Franco's hope that we will meet in Italy in person, hopefully for the inception, if not in the summit. It's good to see Shamshad, John, and Dean Yoshino, and thank you for your contribution. I was earlier this afternoon, I was attending a meeting with the G20 Sherpas to convey the recommendations from the G20. And it is a huge task because I think selecting out of so many sound and practical policy recommendations that were provided by different task forces is a huge task. I was given a time to present in 5 minutes, and I think I exceeded that, or I doubled that time, just to convey the main messages that we are all discussing today and during the summit season. I think given the pandemic and the associated level of uncertainty, there is a great need for policy recommendations at the sovereign level. And I'm not surprised to see that there is a greater recipient of the G20 policymakers to the recommendations. There have been a continuous discussion at the working group, at the ministerial meetings, as well as the Sherpa meetings for the T20 recommendations. And I think given this uncertainty, as well as the need for provide practical, research-based, sound policy recommendations, what I've seen from the T20 is that the whole community stood up to the task. We have around 150 policy briefs that was produced this year. And I was amazed of the agility or the agile of the T20, how they converted the priorities to adapt to the new environment. The task force, this task force produced around 15 policy briefs with very important and sound recommendations that was discussed today. And definitely many of them will be incorporated into our communique that we're currently drafting, and we will be releasing soon around the two-day summit in October 31st and November 1st. May I, on behalf of the T20 Saudi Secretariat, thank the lead co-chair, Dr. Raja, for the hard work that has been done, as well as Mohammed Al-Dubayan for coordinating the work for this task force. And I will also express a special thanks to the co-chairs of the task force, as well as the authors of the policy briefs. And IDBI for co-hosting this webinar. A special thanks also goes to our co-leading institutions, CAPSARC and KF-CRIS, for their support in organizing as well as in financial support, for which without them we wouldn't have these meetings. There is a number of teams that works for the T20 behind the scene. I would like to extend them a special thank as well. And I will take the blame for the technical issues in the video, the art video. As my technical team said that we should have video will not work well in webinars. And I said we should try it. This is the new reality, and we should challenge the technology. It worked well last task force, but it didn't work well this time. But it is available in our website. It is available in our YouTube channel, as well as in without delving into a lot of details, I would like to thank you all for attending. And this is our third task force. We have 8 task forces to go before the 2-day summit in October 31st and November 1st. Next, we will have task force 4 on social cohesion and the states, which will take place on September or October 1st, on the same timing as today. We will also feature a guest from Italy for closing remark to highlight how Italy will take the agenda forward for social cohesion and the states. Look forward to seeing you all in our coming webinars, and have a great day. Thank you very much.
Thank you very much, Dr. Al-Turki and colleagues and Raja for this past months of super intense work, and hopefully collaboration also with other task forces. A pleasure. Thank you.
Thank you very much to everybody.
Thanks all.
Thank you very
See
much.
you
Very
all
nice
three in
discussion.
person.
Thank you.
Thank you.
Thank you.
Thank you, Franco. Thank you.
Thank you.
Thank you.
Looking forward.
Absolutely. We'll be there. Thank you.
Yes, we'll be there. We'll be there for sure.
Bye.